Hey, what's going on, guys? Welcome back to another video from Uncle Henry, and today I want to talk about beating the stock market, and I want to talk about a few really important things that you can do right now to really beat the stock market, the current economy that we're in, and a lot more about investing topics in this video that are massively important that I really want to cover. Right now, I'm going to be looking at an email that I'm sending out to my email list. This is completely free. You can always sign up for it. I send these out because not everyone has time to watch YouTube videos, but reading a quick email with some facts about option trading or other facts about the market is pretty easy for most people. So again, first link in the description. But here we go. All right, so I want to talk about an email that I'm going to be sending out on Wednesday. This email is referring to an email that I'm going to send out on Monday. So I don't want to waste any time, but you can sign up, get that email on Monday. It's free. And this email is referring to that email, but what I'm specifically focusing on in this email, which I have to fix a little bit in the typos, is the S&P 500 return. So in the past year, right, if I zoom in here, S&P has had a negative 18% return basically, right? So that's the market. It's down about 18% in the last 365 days. Now, if we look at my portfolio, it is down 10.7% in the past 365 days. So yes, Uncle Henry's down. I did not make money in the past 1 year. I have lost less money than the market, and here's why that is better than 99% of people, and it's better than every other YouTuber out there. It's better than every other hedge fund manager out there. And anyways, let me just go over the facts, okay? So instead of tooting my own horn, let me just go over the facts, the objective facts, not the extra stuff. So I am winning about 7% versus the market. Now that might not seem like a lot, but it's actually an astronomically high amount considering these facts right here. So just for some context regarding hedge funds and professional financiers, YouTubers are not professional financiers, and oftentimes they actually outperform these hedge fund guys, but that's besides the point. Let me get to that in a second. The general consensus for major funds is that it's really hard to beat the market over time. 95% of finance professionals cannot do it. The S&P 500 index consistently outperformed 98% of mutual fund managers over the past 3 years and 97 over the past 10 years. These managers who have degrees, who have lots of work experience, who get paid like $225,000, who do this full time, cannot beat the index fund. So one of my answers, you probably can already guess on what you should be doing right now. It's gonna be really simple, investing in index funds, but there's a nuance to it. Let me get to that, okay? Let me get to that. I just wanna show you these facts, which are just crazy to think about, right? So over 15 years, in 1998, on a pre-tax basis, the Vanguard S&P 500 index fund outperformed 94% of general equity mutual managers and 97% on a post-tax basis. So this is, by the way, not just general equity mutual fund managers. It's hedge funds, it's billionaires, it's literally pension funds, it's everyone out there. All these professionals are underperforming the market. They don't know what they're doing. They go on TV, they go on CNBC, and this is what you should do, and you can sell. And like this guy, Jeremy Siegel, right? He was a Wharton professor. I actually went into his classroom because I was at Drexel University, so Wharton is very close to Drexel. It's just a walkover for like 10 minutes. And what I did, I don't even know if this is something I should be talking about, but I would go to all my Drexel classes. I have 4 degrees, by the way: economics, accounting, analytics, and finance. And then I would walk to Wharton because I thought it was a much better school. In theory, it is. It's an Ivy League school, right? I would walk there and I would sit in on classes without telling anyone. I would just listen to the professors talk there. I was a really, really serious nerd back in college. I still kind of am. But I would actually walk in on Jeremy Siegel's classes. So he's famous economics professor at Wharton School. He's on CNBC all the time. And the guy literally changes his mind every 2 weeks, right? I didn't know that. I didn't know that. Like, I thought that the more I learn, the more I earn, which is kind of true, but not in finance, basically. Not in finance. These guys are not doing such a good job. There's just no way to predict the market. But anyways, let me go over some more facts, okay? Less feelings, more facts, okay? A number of smart people are involved in running hedge funds. We know that. Hedge fund managers are insanely uber rich, but they're not insanely rich because of how good they are investing. They're insanely rich because of how good they are at marketing and raising capital. But to a great extent, their efforts are self-neutralizing, and their IQ will not overcome the cost they impose on investors. Investors on average and over time will do much better with a low-cost index fund. So Warren Buffett said that, okay? So he's basically saying that investing in Cathie Wood is not going to outperform the market, and it did not outperform the market. She just stepped away, whatever she's going on with her. but she didn't outperform the market. She only did for a very short amount of time, which is possible for anyone. And I'm gonna go over my results over a longer period of time. I have that a little bit down there. But Kathy Wood didn't outperform the market for a long time. The people that actually outperform the market for a long time are Warren Buffett, Peter Lynch, and there's a few people out there, like Peter Lynch is the Magellan Fund guy with Fidelity. Very, very few people actually beat the market over a long period of time. So that's why, again, going back to winning by 7%, 98% of people do not do that. All right, so let's go into the next one. I own, this is kind of a joke, okay? I own last year's top performing funds. Unfortunately, I bought them this year. And the only reason I added this, although this is a joke, it's very common that whatever outperforms in one year underperforms the next year. So whatever underperforms and then outperforms. So things are literally not that predictable, right? Whatever does really well, like Bill Ackman did super, super well for a very, very long time, right? One of the billionaires, hedge fund guys. And then he did really, really bad for a long time as well. So there really isn't any consistency to any investor out there. The only consistency that I have had is selling put options, put credit spreads, covered calls, and sticking to the basics, as well as index fund investing. And I'm gonna talk about all of these things towards the end because I first wanna educate you on all of the facts, okay? So let's do the next thing, which is the next statement is, why does indexing outmaneuver the best minds on Wall Street? So indexing means that you buy an index fund like SPY, VOO, VTI, QQQ, all these are index funds. QQQ is the NASDAQ ETF, SPY is the S&P 500. So that's really all it is. So let's talk about why indexing actually outmaneuvers all these brilliant Wall Street people, okay? So paradoxically, it is because the best and the brightest in the financial community have made the stock market very efficient. What that means is, and this is all I learned in college, literally, I didn't pay because I was poor growing up and I was smart and I did good in school, so I got a scholarship, but still, Drexel University is like 65 grand a year and I went for 5 years, that's like $300,000. So my $300,000 education right here. Markets are efficient and there's nothing that you can do about it, okay? There's no beating the market. So that's like the short thing that you learn in college. That's like literally all that you learn in college. It's like, what the heck? What am I paying for? And what do people spend 5 years doing? But anyways, the markets are very efficient because all these smart people are looking at stocks, and because they all have an opinion and all of their collective opinions make the stock price is pretty right most of the time. So when information arises about individual stocks or the market as a whole, it gets reflected in the stock price without delay, making the stock a reasonably priced as another stock, right? So if Apple's at 100, Apple probably is worth about 100. There's really no way to be like, hey, Apple's worth $95 exactly, because finance isn't like a science. It's not like a mathematical equation. It's based on the markets, it's based on emotions, and it's based on other people. And because of that reason, actually during my college degree, I took some biology classes because I wanted to be a doctor, and I was also studying biomedical engineering. I'm a huge nerd, I just wanted to help people, right? So at first I wanted to be a doctor. And actually, one thing that I realized is that the stock market is more predictable based on biological models. So based on how people think, psychology and biology, you can predict the market much easier using those type of models than mathematical financial models. So finance is, I don't want to say it's a waste of time, but it's not that useful to watch the news and listen to finance all day. So active managers who frequently shift from one security to another security actually detract from performance. They don't do as well. So literally you over trading and over analyzing stocks is doing more harm than good, which again, going back to some advice, I'm not a financial advisor, but I'm higher net worth than most of those financial advisors. I also worked in financial advising. So anyways, I'm required to say that. But if you just stick to being consistent and being simple, simple scales and fancy fails. So doing too many things and trying to overanalyze stocks is literally doing yourself a disservice. It's much better to hold high quality stocks for a very long amount of time, or just to simply go with index funds, or to simply do the income strategies that I talk about on this channel and in my small account playlist, which is covered calls, selling puts, and spreads, right? Those things are proven to work because when I worked at Goldman Sachs, I did some research, I also read research, and I know that they work over a long period of time. Now, the last thing is Uncle Warren Buffett and others, they have done pretty well in the market, right? But most people do not do well. So back to me, Henry, what are your results? What have you done? We know that this year you're down by, 20 you're down by like 16% where the market is down by like 24%. So you're winning by about 7-8%. Doesn't sound that good to me. Well, again, 98% of people can't even get the negative 24%. They do worse than negative 24% this year, right? Or if the market does 30%, they don't get 30%. But anyways, in 2022 so far, I did some more math. I'm actually down about 16%. So I showed you the past 1 year, which I'm down 10%, but on year to date, I'm down 16% versus the market being down 24%. So again, I'm winning by 8% this year or 7% in the past 1 year, okay? In 2021, I have a 59% return. I have a video on that. I send an email with a link to that. It's on my channel. You can look that up, right? So I have a 59 point something percent return versus the market had a 28% return. So I beat the market in 2021. Now in 2020, I crushed the market. I had a 700% return. Just gonna be completely honest, I used a lot of Tesla stock. I did lots of put credit spreads on a weekly basis on Tesla, and it ended up working out really well. I actually did a lot of call credit spreads and put credit spreads and iron condors on Tesla in 2019. So I also had a really, really good return. I also had some leaps in 2020. But anyways, 700% versus 16, and then 489% versus 31. So I had a lot less money in 2020 and 2019. So it was actually a lot easier for me to take on massive risk with a smaller portfolio because I didn't really care about losing 10 grand in 2019, or I had like 100 grand in 2020. So I didn't care as much, and I actually got up to 700 grand, from 100 grand to 700 grand in 2020. So that was pretty insane, but you know, it is easier to grow smaller amounts of money than large amounts of money. It's easier psychologically because you don't care as much about the smaller amounts. It's easier because you can take on more risk. It's just easier in many, many ways. And Warren Buffett has actually said that he can make 50% returns every single year if he had a smaller amount of money, like $1 million. So for him, that's small. For me, that is big. For me, a smaller amount of money is something like less than 50 grand. That's smaller money. For Warren Buffett, $1 million is super, super, super tiny, right? But it has become harder for me, but I'm still beating the market. I more than doubled the market return here. And then this year I am winning. So again, this is a really, really big deal for me. And now I want to tell you on how you can do the same thing, right? How you can basically do this. So, and also I just want to admit that before 2019, I had small returns, but still I was beating the market in most years. And you know, honestly, I was a value investor because university teaches you that value investing is the way to go. Like, all the professors will tell you how value investing is better long-term. They are right. Value investing is safer and better long-term in many scenarios, right? But it's only better for retirement. If you're trying to grow 10K to 70K and you're trying to get rich, you're not gonna get rich off of value investing. Like, doing what Warren Buffett does and buying really good companies at a very solid price. So buying a company for $15 and then in like 2 or 3 years, that $15 stock becomes a $32 stock. That's great. That is amazing. Like, that's literally doubling your money. That's phenomenal, right? But you're not gonna get rich that way. You're gonna get rich by taking on more risk and doing spreads and more option trades. Whereas value investing, it can make you wealthy over time, which is fantastic. I totally recommend it if you are patient. If you have like a 10-year, 15-year horizon, that's fantastic. Like, investing long-term in index funds, in value stocks, and then holding them for a decade works. It's gonna keep working, right? Because most people aren't patient. They're trying to get rich quick. And I don't blame them. I wanted to get rich quick. I did get rich quick, but it wasn't that easy. And I had to use a lot of my understanding, learnings from Wall Street. And honestly, I took risk. I took massive risk, and it ended up paying off. And still, every single day, every single Monday, Wednesday, and Friday in my Discord community, I am taking risk. I'm posting trades, people are following my trades. And so far, I've been doing really good for basically since 2019, I've been crushing it. Before, I was doing good, but I didn't track my results as heavily, and I honestly had a lot less money. But since 2019, 3 years in a row, I'm doing good. And in a bad year, this is a bad year, I'm still doing good. I am doing good. Most YouTubers push really hype stocks and they do great for a certain period of time, right? NEO, for example, is actually beating the S&P 500 this year. It's doing less bad than the general market. Is it down? Yes, it is down. So did we lose money? Sure. Other people lost more money. This is a relative game. So you can play the absolute game, which is make 1% a week. It is kind of possible, but when the market is down, it's really hard not to be down. Like everyone's down. Billionaires are down. Warren Buffett is down, okay? So I am down less than the market, and to me, that is a massive, absolutely great win. And I'm really proud of it because in good times, I'm killing the market, and in bad times, I'm losing less. I'm literally losing 50% less than everyone else. So again, I have surpassed Wall Street. I've surpassed 98% of people. I've surpassed billionaires. Like, they don't have as good of a return as I have. That is just the fact. I'm not being cocky. It's just what the fact is, okay? And yeah, sure, I have a college degree, but it didn't really teach me everything that I needed to know. Really what taught me was working on Wall Street and understanding and doing trial and error. Again, my first few years of investing were awful. I really didn't have the best returns. And what I did my very first year was I bought Hertz. This was so long ago. Carl Icahn, another billionaire, bought Hertz, and I'm like, if a billionaire buys this stock, I should buy it too. Well, I was wrong and I lost tons of money. Tons of money was $3,000, but that was a lot of money for me back then because a whole summer as a intern, you don't really earn that much. So $3,000 is a whole lot of money. So anyways, I was losing money my first few years, which is again, why I wish I had a mentor. I wish I had a community like I offer today. I didn't know any of this. I didn't have anyone that really helped me. I did have mentors, but I could only talk to them. I couldn't follow their trades. I could just talk to them. So I really wish I had a shortcut. But yeah, once I got over $1 million, it did become much harder to keep scaling my portfolio at the same rate that I have been. But again, I'm beating the market, and I'm just going over this email, which I'm sending out on Wednesday. So again, you can sign up for this free email. I send out these emails all the time. It's about investing, my life, finances, retirement, sometimes tax planning, budgeting. I just love talking about finance, and I love just educating people. So this is totally free email, first link in the description. But you basically have 5 choices. You can try to beat the market yourself, and 95% of people fail, and 98% of people fail over a long enough time horizon, and most people give up. You can also do index fund investing, which I totally recommend. It's better than number 1, which is learning it yourself and getting super confused, which is number 3, watching lots of YouTube videos. In my opinion, YouTube is great. I love YouTube, but it is a waste of time learning from different people, and most of these people are not educated. So I don't know anyone else on YouTube that's teaching options in investing that worked at Goldman Sachs or has a finance degree. Most people out there, especially the ones bigger than me, they're fantastic personalities, they're great on camera, but they don't have the same background or education, right? So you can definitely do that, but again, I do think that that's gonna be not the best route. Also, you can work on Wall Street yourself. I think that getting into a Wall Street bank or working in finance will teach you so much. Getting a job at Goldman Sachs is harder than Harvard. However, you can absolutely get a job at a bank or just learn from like the financial advising industry. I don't love financial advisors because they charge like fees, like a 1% fee, which to me is kind of like sucking blood from a customer for a very long time. Whereas, I just don't like that business model. And also they don't have the best intentions. So a lot of financial advisors will take your money and then they want to put you in things that will pay them commission. So just not a very ethical industry in my opinion. Or number 5, you can always just talk to me. You can talk to me, talk to my team, join Discord, and just watch all my trades, get a full community, a course, and we just launched the Unlimited Option Trader, which I'm still working on the website, but basically you get a combination of everything. You get myself, you get coaching, you get other coaches, you get a community, you get everything to be successful, everything to be in that 2 to 5% range, or even that 1% person that just trades options and makes a living out of it. So again, thank you for watching this video. If you made it this far, I really appreciate you. I just can't thank you enough for being a part of my community. And if you're subscribed, thank you. If you like my videos, thank you. I just love educating people and I love working with you guys, and just such a pleasure. I'm so happy that I get to do this. So again, happy that you watched all the way through, and I'll see you in the next one. Bye. Oh, and give me a fist bump.